Welcome back. Well, the private equity world is seeing a change in leadership to the next generation throughout the industry right now, and that includes at the Carlyle Group. Founders David Rubenstein and Bill Conway recently announcing that they were stepping down as the co-CEOs of the Carlyle Group. That happened last October. The firm then announced that they would be replaced by Kyu Song Lee, who has been with the firm since 2013 and was formerly head of credit. And our guest this week, Glenn Youngkin, the co-CEO of the Carlyle Group. Great to see you, Glenn.
Great. Thank you for having me.
Thank you so much for joining us. And it's interesting because you're seeing this next generation at Carlyle, but also you're seeing that at the Blackstone Group. You're seeing that at other firms as well.
Yes.
So you really are seeing this generational change at private equity firms. So we want to get your take on where the growth is at the business and how you would like to continue this great success that you've been overseeing. $195 billion in assets under management at the Carlyle Group. You raised $43 billion last year alone.
We did.
Wow. And your funds are up in the double digits.
And our funds are up.
20%?
More 20% for across the firm. Our corporate private equity funds are up over 30. Our energy funds are up at 30.
Oh my goodness! Congratulations.
Our real estate funds are up close to 20.
How do you keep this going, Glenn?
We don't. And I think that's one of the key messages right now that we're discussing with all of our investors is while the global economy is in as good a shape as it's been in a long, long time, the investment environment is really hard. And the portfolio that's in the ground, so the funds that are currently invested, are continuing to perform very well. The challenging part is finding new things to invest in today. And that's where firms like Carlyle and some other ones that you were talking about really are at our best. We're big firms. We have deep capabilities. And when we are able to invest in a company or a real estate asset or an energy project, we bring to bear lots of skills and capabilities to actually improve them, make them better. And that's where we get our returns from.
I know you do. That's why we want you to tell us a bit about where the growth is. Now, we're worried about credit spreads. The markets are looking at credit spreads. Your credit business has been growing, and you think that is where much of the growth comes from in the coming years.
I do. We have a credit business today that's quite large. It's a little over $33 billion in assets under management today, but we think it can be substantially larger, and that's because the private credit business, much like private equity, private real estate, private energy, private infrastructure, is at a point where investors are recognizing there's a premium to being in private credit as opposed to liquid publicly traded credit. And that premium is drawing investors into the market, and there's a lot more opportunity for us to do interesting structured credit plays, lending into the kinds of private equity deals that many of the smaller firms do. And as a result, we've begun to build a very large credit business.
Tell me about the policies out of Washington and what that means for your business, because I know that you've been waiting on this infrastructure project coming out of Washington. The plan, $200 billion in federal money. We're going to see private partnerships. I want to see how you're going to partake in that. The energy business and this rollback in regulation had to be a positive. So how does all these policy changes coming out of Washington impact how you allocate money?
Yeah, it has less to do with how we actually allocate it and much more to do with our optimism that it will perform the way we hope it will perform, because we're now getting tailwinds to a lot of the segments where historically there might have been headwinds. And those tailwinds are reflected in a lot of the things you just went through, Maria. So first and foremost, tax reform. The opportunity to, in fact, lower tax rates by 40% across our U.S. portfolio companies and take that capital and reinvest it in growth is huge. And so we do see a net positive for our entire U.S. portfolio as a whole from tax reform. Regulatory changes have been material, and they're showing up in all aspects of the business, from the financial services sector through to the infrastructure world and an energy world. But I think most importantly, we just see a positive business climate coming out of Washington. And so for years, I would say it was neutral to negative. And now we see it neutral to positive. And that just gives business leaders, CEOs, boardrooms, executives that are making decisions around building plants and launching products more confidence to do so.
Do you see any value in any of the businesses of GE?
Well, so GE is undergoing a massive reevaluation of their overall strategy. There are wonderful businesses inside GE. That's what makes GE GE. And I think everybody is standing poised and ready to see what their strategic review brings forth as far as what businesses they're going to stay in, whether they stay as monolithic GE or whether they split into separate companies. But I would say the world of private equity is watching to see what happens there, because they are just such good companies.
I bet. What an incredible fall they are.